Thank you so much for joining SummerSaaS today. We're highly excited to have such a great number, such great people and investors as yourself. So our panel today is about funding funds, through COVID, post-COVID, and maybe just by way of a brief introduction. So we have Bjorn from EIF, we have Ufuk from IFC, and we have Dillon from Asante Capital. I will let guys maybe introduce yourselves briefly. What's your role and position within the organization, and what you're doing, and why you're excited about startups, maybe. I don't know, in whatever fashion. I have Bjorn in my left.
Okay, I'll kick off. Bjorn Tremmerie. I've been with EIF for 19 years by now. Joined as a victim of the dot-com crisis, was working for a direct investment fund, and started my career in investment banking. At EIF, I'm responsible for the tech investments. We're an intermediated model provider, so we're a fund of funds. We don't invest directly in startups. We typically invest between 1.5, 1.6 billion per year. This year, it might be a lot more because we're also implementing anti-COVID relief measures. So we want to support the economy. We're all about supporting innovation and entrepreneurship in Europe. I'm on the tech side. There's also a team that is on the lower mid-market buyout side. It's really by supporting funds that we try to foster innovation and entrepreneurship, support SMEs, which are the backbone of the European economy. Why I'm passionate about startups, because basically technology innovation, it's the future. So the best way to predict the future is to invent it, and that's what startups basically do. And I'm happy to be part of the little piece of funding chain that makes that innovation gets the necessary funding and can help us not only navigate the pandemic and the lockdown, but also provide solutions for other challenges that the future may hold for us.
Thank you, Bjorn. Ufuk, do you want to?
All right, yeah, I can go. So Ufuk Demirci, I'm based in DC. I'm with IFC. I'm heading the venture funds operations for IFC. And after spending 10 years in the deep tech sector in a fund on the other side, I joined the fund of fund side. So I'm with IFC for 10 years now. We invest about 700 million, I think, annually, but about 200 is in venture funds. And then we also have a venture direct program, about 100 million. So 300 million combined in venture funds, co-investments with these funds that we invested in, plus 100 for direct deals that we do. And as far as why we're passionate, I mean, I think Bjorn just nailed it. It's the future. I mean, when electricity was first invented, I think it was a novelty, but I mean, you have like electric tweezers now. So just like that, technology will be everywhere, and this is the path to go, and it's good to be part of this.
Perfect.
And hi, I'm Dillon. I work for Asante Capital. We're a private markets advisory firm headquartered in London, but we have offices in New York and Hong Kong. We're active in the primary capital raising, so that's working alongside venture capital firms and general private equity firms in raising their capital, as well as also active in secondaries transactions and direct investments. We've raised about in the past 10 years, we've raised about $35 billion worth of capital. And of that, probably $4.5 billion of that is to venture strategies across 12 funds and 5 managers. As Bjorn and Ali said, venture is definitely one of the most exciting segments of the private markets, and it's great to work alongside these managers and see their portfolios of the companies of tomorrow, and again, be part of that capital providing chain.
Perfect. Thank you. Maybe to kick off our discussion and to warm up a little bit, I was wondering, the theme of the day is COVID, so no Zoom call goes without, brief wrap up of the current COVID environment. So I think I suggest that our call is not an exception here.
We just did it with Bjorn before you guys joined.
Okay. Sorry. But maybe, obviously it impacted all, our personal, professional lives quite a lot. So maybe, you can share your own perspectives, how it impacted your business, maybe as a fund of funds investor. But maybe there are some anecdotes you want to share. Just briefly, maybe, I don't know. Ufuk, maybe we start with.
Yeah, sure. It didn't really change our the way we process things. I mean, other than, of course, everything is Zoom. We're breaking it down into sessions now instead of having 2-3 days of straight due diligence sessions. It's just 3-4 days of 2-3 hours. We're not traveling, obviously, and we're doing most of the things in writing. So you write, send something back, and you just jump on a call to wrap things up. I actually find this method of doing due diligence much more efficient, and it's more on the spot. It doesn't waste time for anybody, and also it's more economical, and then you can obviously do the existing clients like this in a more efficient way. And there are new ones, obviously. We can't continue like this. You will eventually want to see them, but I think an organization like IFC has its advantages because we have local offices. Our local office staff can meet people, and then we can just hop onto the due diligence on Zoom. So I think we got more efficient and faster because of this.
Interesting.
I don't know, Dillon or.
Yeah, happy to. I mean, on top of the, without traveling, just jumping from one call to another rather than having to deal with the logistics. I think it certainly has democratized the fundraising process. As a GP, you now have the ability to reach out in a much wider universe of LPs via just a phone call or an email than beforehand being tied down by sporadic roadshows or geographic limitations. We could see, at least at Asante, that the fundraising process is probably going to be much shorter than beforehand because it's much more efficient. It now comes down to a few update calls and virtual on-sites, and maybe less from 3 to 5 months, rather than beforehand the average fundraising for a GP would be, that we would work with is 14 to 18 months, right?
On our side is a bit a mixture of both things. We had efficiency gains as well. Some processes that we were talking about for a long time all of a sudden were capable of being implemented. One anecdotal topic was digital signatures, for instance, that all of a sudden was embraced by the whole organization. I must say I was surprised as well how smoothly we actually, as the whole EIB group, so thousands of people went from on-site working most of the time to teleworking. Infrastructure's held up, technology held up. So that was something that we have this business continuity plans, but you always think, yeah, we'll never need it. And I'm doubtful whether it would work when we need it. Well, it actually did. So that was anecdotally something positive, I'd say. And it seems to hold up for many of the other organizations out there. As to the job itself as a fund of fund investor, it allowed us to be very efficient with the groups that we knew already. Unlike direct investors, we cannot test a product or a piece of code. So the main asset that we can invest in is a team. So where we had severe complications is on investing in first-time teams that we would have never had a contact with. That, unfortunately for us, during lockdown, we didn't find a solution to. As soon as there was possibilities in between lockdowns to go and meet people, unlike IFC, we don't have a network of local offices throughout Europe. We're centralized mainly in Luxembourg. We were not even allowed to have people in our office or even to meet people. For complete first-time teams or complete new relationships for EIF, that has caused us occasionally some issues, and there has been a delay in our way of going forward. So we leverage to the maximum sometimes meetings that we've had with some people of those firms that we met in conferences or that we had an unofficial meeting with. But at a certain moment in time, a completely new proposal, we had to put that on hold, unfortunately.
Wow, remarkable. Maybe to move on the discussion a little bit to the so basically we're talking about startups today, and this companies or VC-backed companies, and this is the main sort of focus area. To mention a little bit about the backdrop of our discussion. Looking at some statistics, according to Crunchbase, only in the first half of this year, about 300 billion of capital was raised by VC-backed companies. So that's an absolute record ever. On the other hand, 2/3 of this volume was taken by late stage companies. On one hand, on the other hand, we see that the number of exits, the number of IPOs, the number of SPACs, and the number of unicorns is also record high. According again to Crunchbase, 250 private unicorns were created in the first half of this year, which grows almost like the total number of private unicorns by almost like 40%. So that's totally unprecedented, development in VC sort of backed environment. Do you feel with all this change and also the shift, and maybe another data point to mention here, so 50 late stage funds have invested over $1 billion each in the first half of this year. So in total, there were 50 funds that invested over $1 billion versus like purely VC multi-strategy sort of funds. There were only 9 of them who invested $1 billion each. So what's your view in terms of like the environment overall? Is it sustainable? Do we see a shift to like later stage businesses? Is it like where the capital flows are going to be taking? How do you see it as a fund of funds? What does it mean overall?
I can go first if that's okay. I think, first of all, venture is here to stay, and this is real. But I cannot deny that, in my opinion, there's a rich froth on top of it now. I think for the past 2 years or so, it has been forming, but it is now there. But it's not same in every region. Although every region feeds itself because they look at the multiples happening in other regions. So usually starts in China and Southeast Asia. And then when we did our mappings a couple of years ago, we identified Brazil as the next frontier because it was untapped, valuations were fine. And then SoftBank entered there, and then a lot of other investors entered. All the MBAs started going back to their own countries to start companies. And now Brazil, the fund managers are complaining to me that they do not have enough capacity to meet the demands. The rounds are moving too fast. And just imagine, these are all private, hardcore. They can move really fast. They're complaining that they cannot move fast because round starts and so it's a trickle. It starts from there. It jumped into Brazil, and then it's going to follow the next path, right? The next one, I think, was Africa, because a lot of development money is going in there, but it's still not bad. I mean, it's still in development. And then there's Europe. Europe is still okay. I think it's not going that crazy, although you see that thing affecting it there as well. I think it's not sustainable, but it doesn't mean that it's going to come crashing down. It's just that we have seen other examples in India, for example, in 2014-16 period, where big tickets just go in there, and then you kind of have an insight as to how some of the decisions are made, as like throwing a dart, let's make this company our next unicorn kind of decisions. When these start to happen, then obviously it's going to crash at some point. I think the other interesting thing is that when these things correct itself, unfortunately, the late stage fund ones, especially in India, did not really feel the big hit. Actually, it was the early stage ones that actually felt, because the big ones had enough money in their bank to delay their funding and hope that in 18 months or so, 2 years, maybe things will correct. But the new ones coming into the market, especially the ones who did their pre-A's, when going into A's, they were hit 40% or so in terms of their valuation. So I'm not saying the same thing will happen, but we certainly see that the direction is a little bit on the optimist side, and there's a bit rush to valuation now, which would be better if it kind of cooled off a
Bjorn,
little.
what do you think? Do you think it's gonna crash as well quite soon?
But there's quite soon, I don't think so, because you need to look at some of the elements that drive the environment that we're in. So of course we're apparently in, and I say apparently because the big crisis. But if you look at some of the market's recovery, especially in tech, have fully recovered. There's so much money that is being poured into the industries. It's three or fourfold what the quantitative easing that we've observed after the big global financial crisis. All that money is looking for a way to returns. What people have seen is that technology seems to be, as we discussed just before, seems to be the area that is making sense. Not only it's the future, but it's also the thing that kept us alive during the pandemic. Digital consumption, digital entertainment, food ordering, online food delivery, Netflix, Spotify. You can stay home and live your lives as if nothing was, and that's all teleworking, all thanks to technology. So all that money is looking for a place to invest. So that is also why that bulk of money is probably going in the areas where you can write big tickets, the late stage part. It's not surprising that in the midst of a pandemic, not that many people are taking the risks of setting up new shops, be it a new venture fund, be it a new startup. So I think what is getting funded, the business models that are proven, that are safe, also for the tourists or the hedge funds that go into the late stage segment, they see an opportunity. So I have a big deja vu with 99 2000. I cannot, of course it's always different, but I have a big deja vu and there are similarities. The markets is spiking, everything is at the peak. Fundraisings, I have fund managers that invest a whole fund within 12 or 18 months. When I started doing this at EIF, we wanted to avoid the nuclear winter after the .com, and we said, people, don't make the same mistake. We never ever want you to invest your whole fund in 18 months again. So we imposed people that they could only draw 25% of their fund in any single calendar year. Now what we see is that people again invest in 12 or 18 months at the highest valuations that we've seen. There are many smart people, far more smart than I am probably, that explain why it's all okay and we shouldn't be worried. I just know that there's so much money in there. There's perhaps inflation lingering around the corner, but nobody's going to increase interest rates anyway soon, because that would kill the recovery of the economy. So I think that there's going to be an abundance of money still available in the market for the next 2-3 years that is going to stop the correction that should be coming. And that will make that possibly what we're seeing now might still make that the music is on for another 2 or 3 years. And then it will come to us, whether it's with a bang or just the balloon slowly deflating. I don't know. I just know that when I cannot explain the valuations anymore, something is bound to happen. But I'm not the doomsday prophet. I see as well that my portfolios exit at far higher values than in the books. I'm making fantastic returns. If you want to play the market, just do what every wise man would tell you. Be consistent, continue in good years and bad years to invest, and ultimately you'll make a decent return. But I don't know on current valuations what you need to do to even make a 10x. You cannot make a 10x on today's valuations like you could do on 5 years ago, the valuations of 5 years ago. So I'm not, I'm a fund of fund investor. If I knew it better, I would either be in trading or I would be the direct investor. But what I observe is that we are seeing something that is not sustainable in the long term. But I cannot predict when we're going to hit the cliff. Sorry?
Yeah, that's actually quite interesting, because I think we as VC, we see that obviously it's a vicious circle, right? We have startups who want better names on their cap table, who want renowned investors, who apparently will add them for the next round. They want higher valuation, so they push us and squeeze us. Then these better names, go raise capital from the fund of funds. So it's all interconnected. And, if you look at the statistics as well, this year, in the first half of this year, the number of funds below 50 million, it's probably like all-time low since the dot-com bubble. So it has dropped from like 60-70% of the total funds raised in the given period down to like 30 to 40%. So it's obviously the bigger guys are consolidating most of the capital, taking most of the money, and you are obviously the guys who are funding these bigger guys.
Well, we fund the smaller guys as well, but I would not necessarily, perhaps, I don't know whether it's because there's no future for the smaller than 50 million funds. Perhaps nobody is currently stepping into the cold water and launching, because a first-time fund in Europe and perhaps other parts of the world, depending on your strategy, would be somewhere up to 50 million. I think anything below 30 million in Europe doesn't make too much sense. But it's not because we don't see them that their strategy is doomed to fail. I think the ones that had a 50 million fund 3 years ago are now raising a 100 million fund, just because they can. And of course, I don't think that the returns that I start seeing in Europe, we finally start seeing DPIs at very attractive levels. I have, even for the first time, and so look at some of the investors in UiPath, the double-digit net returns that they can make on that. Nobody ever thought that Europe would deliver that type of returns, and I could name others if this weren't a recorded public session. But you start seeing very attractive returns. I doubt that the Tiger Globals or the other large, that they're going to make 20 times the fund.
That's actually quite interesting. You mentioned US versus Europe. So in the US, the funds that are above 250 actually raised about 80% of total capital. So they are more consolidated. In Europe, we see a bit of a different trend. About 50% is taken by the funds that are above 250, and actually more is taken by smaller funds. Do you see that Europe will be, obviously US has raised like 5-6 times more capital in like the first 6 months of this year, but do you see that Europe is going to be following in a way the trends in the US? So are we also going to be shifting towards bigger funds, larger funds? What's your opinion?
Yes, and from the EIF side, we would actually make a policy statement out of that. I need to make certain that what I'm saying now is not seen as a US versus Europe or Europe versus Asia. Currently, we're very happy that the whole of the early stage ecosystem that has been built over the last 20 years that finally starts generating returns is also creating unicorns, decacorns, and is attracting appetite from large funds to invest in them. The reason why it's US firms and Asian firms investing in them is simple, because there are hardly any European ones. So currently, we're already happy that we're getting funded. But if I put my policy hat on, we need to make certain that we use this momentum as well to build a European late-stage segment that is capable of funding the local champions for a rainy day, if ever valuations in Europe were not to be so attractive anymore compared to the US. That many US firms might say, okay, I don't need to travel to Europe anymore. I can get the same quality but same price now as in Europe. I'm going to fund it more closer from home. So we need to take, from where I sit, we need to take also the opportunity to actually build a late stage ecosystem in Europe, not only by attracting foreign money into Europe, but also building a local base. So yes, I would hope that we see that trend, but not with the aim of killing the early stage segment. The two need to be in sync. In the US as well, you have the micro funds, as they call it. In Europe, every fund would almost be a micro fund, because I think the bar is $100 million in the US. Well, half of my portfolio would be micro funds then in US terms. You need both, because if you dry up the pipeline of the Tigers and the Sequoias, who's going to fund those early stage risky startups? The likes of you, Alex. So you're not going to disappear.
Yes, we're here to stay for sure. Thank you. Dillon, what's your view? You've been working with many fund managers, helping them raise capital. How do you see, any advantages or disadvantages? Obviously, US placement agency would also want to work with larger funds. We understand that, but focusing on like smaller funds and then Europe versus US, how would you see that dynamic play out?
Well, we're definitely seeing a greater attraction to European managers that didn't exist 5 years ago. As Bjorn was saying, as Alex was saying, the European venture space has definitely matured over the past 2 decades since that nuclear winter, and has started to attract more capital globally. We're starting to see US pension plans, Asian corporates, family offices globally begin to take note of European venture firms, which hadn't beforehand, on just not only a pan-European basis, let's say the top 10 groups, but also beginning to look at some of the more regional managers too. So I think that the capital, going back to Bjorn's point, is coming towards Europe and across the early stage all the way to the late stage.
Interesting. Maybe to shift like the regional versus size, conversation a little bit to talk about the sectors. So software, as we know, has been eating the world for the last decade, and the share of software businesses that have been raising capital has almost like doubled. So software companies are raising probably about like 40%, 40% of total capital versus some other sectors, hardware, entertainment, etc., other parts of tech ecosystem. What's your view in terms of, and SaaS is the theme of the day, everyone wants to be SaaS. Obviously, if you don't put the word SaaS or AI in the pitch deck, you don't get any money. So what's your view in terms of like sectoral focus? Is it better for the funds to be more sector focused? Would you yourself as fund of funds be more supportive of people who are more focused rather than more generalist? Or they're prone to more risk, if the tides change, and then, as we've seen with crypto, can go down, etc.
I would think that it's quite difficult nowadays to go to market putting yourself out as a generalist fund manager. The GP landscape and also the LP sentiment has moved towards wanting to see differentiation by sector focus or by geographic focus as well. And so that is how we'd probably position, if you're a VC manager trying to attract capital, that you prove that you could partner with the best of the startups.
Bjorn, what do you think?
We would actually fund all strategies as long as we believe that the team that is presenting it is the right team to execute on that strategy. I wouldn't do all strategies, the ones that are outdated. If you want to break the e-commerce model, I think the battle has been. You can find niche sectors, but e-commerce is you have the Amazons and so you can find niche verticals, but that has been done. But other than that, I think there is no such thing as a generalist that would say we do everything. You would have generalists that have more than one vertical. So we see. I would be worried if a generalist said, "Look, I would invest from anything from life sciences to e-commerce to quantum computing," and them not having the specialty. I see many teams that now have, plain vanilla VC firms that now have a fintech arm, they have a SaaS arm, and they can also do a bit of the digital health, for instance. And then they have individuals that are actually experts in there. I think that they're as well with these experts capable of competing against a pure digital health or a pure fintech fund as well. I would invest in a pure fintech fund if it's the right team. A team that said, look, I used to do clean tech, I failed at it, and now it seems to be fintech, the flavor of the day, I'm going to launch fintech. I'm not going to invest in it because I believe in fintech. It has to be something that matches. It has to be the right team with the right strategy. And I would invest in a generalist team that has 3 sub-teams, each being some of the most expert people in their domain. If I believe in the people, I would fund them.
Ufuk, maybe the last question to you, considering the IFC focus, and Bjorn mentioned clean tech. So, there is a lot of discussion today about social responsibility, governance, and IFC. You focus on a lot of developing markets. So, how would you, as a fund-of-fund business, how would you look at that from that perspective? How is it ESG? Is it important for you guys in general or not?
Yeah. I mean, obviously, that's what we're here to do. Not just to make money but to implement the governance and ESG. So that focus hasn't really changed. We're still doing it, and it's actually, we have even more tighter restrictions and requirements now. So if anything, I think the focus has increased on ESG and development. And I think it's not just IFC. We see a lot of bulge bracket investment banks launching their own asset division, and there's big focus on ESG on their end as well. So I think it's a request or demand coming from the investors globally that people are more conscious about these things.
And we're running out of time. I would like to thank you so much for joining our session. I see that we had close to 90 people watching us, so we ended up gathering a bit of steam towards our panel, so well done. Thank you so much, and have a great day. Thank you for joining SummerSaaS. I hope
Thank you.
All right. Thanks.
you all.
Thanks for the invite.
Cheers.
Bye-bye.
Take care.